All right, good morning.
Let's do roll call. Yes.
Oh,
Thank you, Mr.
call
Green.
roll.
This meeting is being conducted as a virtual and in-person meeting. So I will do roll call of the trustees to confirm attendance. Ms. Proft.
Here.
Thank you. Ms. Mee.
Here.
Thank you. Mr. Green.
Present.
Mr. Rue.
Here.
Ms. Martin is absent. Mr. Gatto.
Here.
Thank you. Ms. Martinez. Mr. Jones.
Present.
And Ms. Langton. Here. Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, Chief Counsel Stephen Rice, Deputy CEO Louis Lugo, AEO JJ Popovich, CFO Ted Granger. Investment staff presenting today are Vache Masarajian, DD Azabedian, Corp. Win. Consultants on site are Makita, Stepstone, Alborn, and Milliman. Trustees, please use your raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. And now we may proceed with the agenda.
Thank you, Linda. Item number 3. 2449.
Yes, trustee Mee is participating under AB 2449. Ms. Mee, can you please confirm if there's anybody under the age of 18 in the room with you?
I'm alone. Nobody's here.
Thank you very much.
So we need a motion for approval of the minutes from September 10th.
So moved.
Second.
Okay, thank you. Ms. Proft,
Aye.
Ms. Mee,
Aye.
Mr. Green,
Aye.
Mr. Rue,
Yes.
Mr. Gatto, Ms. Martinez, Mr. Jones,
Aye.
and Ms. Langton. Aye. Okay, the motion passes unanimously.
Thank you. Item number 5, public comment.
We don't have any requests.
Okay, moving on. Executive update, item number 6.
Good morning, Mr. Chair and trustees. That was a great committee meeting we had this morning. We have a full agenda. So if we could turn to page 5, please. Slide 5 shows the results for major financial markets through the end of September. And I think there's very surprising information on this page. Calendar year to date, we can see in the top 2 sections of the MSCI ACWI IMI Index, Global Equity Markets, and the Bloomberg US Aggregate Bond Index. Calendar year to date, global equities up 18.3%. Non-US is outpacing US, and investment grade fixed income is up 6.1%. So if you look at those numbers, this is a great year for a passive 60-40 portfolio. So in many regards, a broad asset category and investment style diversification is lagging, and that's in the short to medium term. Diversification, however, I believe is the winning long-term strategy, given, as we discussed in last month's offsite, macro cross currents, and at some point investment fundamentals do take hold. And those fundamentals include valuation, include cost of capital based upon risk and return. And these are reflected in our core investment beliefs. This discussion is important given the actuarial discussion that we're going to have later this morning. If we could turn to slide 8, please. Slide 8 shows the results for the pension through the end of August. As of the end of August, the pension was up 1.2% net. AUM represented in the total market value, the bottom left, of $86.8 billion are my three favorite initials, high watermark, HWN. As we could see in the bottom middle, cash equivalents were comfortably at $1.3 billion. Maybe I'll say high watermark again. The next slide, this details results for the fund and our functional asset categories across time and include the various benchmarks. I'll note that the 5 and 10-year performance for the total fund is well above the reference portfolio that we discussed on slide 5. So maybe the passive pure market beta is working short to medium term, longer term, the complexity in LACERA's asset allocation, we're being compensated for that. And once again, that's especially important given the mature nature of the LACERA fund. For the month, we are below our policy benchmark. The fund was up 1.2%. The benchmark was up a stunning 2.3%. And the negative variances for the month are, once again, it's for the month, are attributed to credit and private equity. And I'll start with private equity. Private equity isn't shown explicitly on the table. It's embedded in the growth line. The underperformance of private equity relates to the 2% spread to public equity, which is the benchmark. So we've discussed this theme a lot over the last, 1 to 3 years. And I'll repeat that public equity is dramatically outperforming our capital market expectations. On slide 5, I mentioned that calendar year to date, that public equity is up 18% for the year. If you look over the 3-year period, public equity is up 22% compounded annually, which is just a stunning number. And so if you think about our private equity benchmark, it's that 22% plus 200. So there's a phenomenal private equity program is one that does mid-teens return. So, but our benchmark is it shows underperformance compared to that 24%. So that's something that that we're suffering at the total fund level with respect to what our performance is compared to the benchmark. And I'll also put that 22% in perspective that when the board last went through the strategic asset allocation process, the capital market expectations approved by the board were that public equity would return 7.2% on an annual basis. So that 22% is far in excess of the 7.2%. So once again, just to further punctuate this, private equity benchmarking is difficult during public equity bull markets. So we've said that. I'll probably say it again next month. Credit, which is the other component of underperformance, is in some ways easy and harder to explain. We have great long-term performance in credit against the benchmark, and the 1-month underperformance is fully attributable to a single successful credit investment that was converted to public equity. We discussed this investment in closed session in June, and this investment has introduced volatility into our credit benchmark. Once again, this is the results as of the end of August. We report with a lag. As of today, those mark-to-market losses have been more than reversed. However, that may go up or down over time. And maybe this is a good time to pause on credit for a second, in that there's been, and I know that the vice chair asked a question about this at the offsite, there's been a lot in the financial press about credit being toppy and in a bubble. And so maybe I'll comment on that. And yes, I am worried about credit. But yes, I'm also worried about public equity, private equity, real estate, real assets, fixed income. I'm worried about everything in the portfolio. And I think that in some sense I'm paid to worry. And the board is charged to worry. And I think it's important for us to repeatedly point out that we actively mitigate those worries. We have a diversified asset allocation. We limit our downside by having exposures to many asset categories. We heard in the Corporate Governance Committee that we're exposed to, better part of 10,000 public equity securities. So we're diversified within asset categories and across asset categories. We further mitigate these worries that we might have about any and all asset categories by rebalancing towards our targets. That's something that we do daily through our cash overlay. And equally important, we do continuous diligence. We do continuous diligence on all our business partners and all the mandates that they oversee. So in other words, we do not panic. We revisit our asset allocation, every 3 years, and we're scheduled to start that process again next July. So if we could turn to slide 13. Thank you. These are the results for the OPEB trust through August. The AUM for the OPEB trust is $5.2 billion that we could see in the bottom left. That once again is a high watermark. It's great to have multiple high watermarks, and hopefully that's a course that we can continue throughout this fiscal year. That's hope. You can't plan. That's not a strategy, but we hope that that is the case. The return for the OPEB trust for the month was 2% net. If we could turn to the next page. So this slide shows the results for the OPEB, its various functional asset categories against benchmarks over time. And the top of the chart, the top of the page has a chart referred to as a histogram that shows the 10 years of monthly returns or 120 observances with in various percentiles, the stacks of where each month's return would be. For August of 2025, we could see that the 2% return has us in the column of 2 to 3% returns. And one note of difference between this chart and the similar chart that we have for the pension is that the pattern of the distribution is more scattered, and that the pension has a much tighter distribution of outcomes, and that is a form of a risk control. And it's important for the pension, given the actuarial situation of the pension as a mature plan. OPEB, as we discuss monthly, is a different plan. And with more illiquid investments over time, this chart should tighten and look more similar to the one that we have for the pension. And there's something that I think is kind of unique on this table. It's something that I've rarely seen. And I'm not going to ask if people can identify it because it took me a while, as a slow news day. There's only one negative number on this slide. And if you look at the risk mitigation row towards the bottom, the 5-year return for risk mitigation is slightly negative. Note that it's better than the benchmark, but I don't think I've ever seen a table with one negative number on it. That's some notion of that markets and how capital should efficiently price is that things don't move in unison. And I think, not that I'm predicting anything, I'm just stating the obvious, that this is somewhat of an anomaly. And with that, we could stay on this slide because I have a bonus round. And that bonus round is that today is my 100th Board of Investments meeting. And so that prompts a question, or maybe it's two questions. A, have I been here too long? Or B, do we meet too much? But we'll put that aside for another day, and maybe we could put that in items for staff review to revisit that. Maybe after 100 meetings, I get to put something in there, and that's it. But so I went through my notes for 100 CIO reports to extract themes. And I'm not going to do a top 10 because that would take too long and we've got a full agenda. So I tried plugging everything into AI to tell me what the top 3 was, and it was really pretty good. So number 1, I bet everyone can guess what the number 1 thing is. Strategic asset allocation. So adhering to LACERA strategic asset allocation is the most effective form of risk management. I think I've mentioned it at least 2 times today. Strategic asset allocation has served as a stabilizing force through market volatility, including the pandemic, inflationary cycles, and geopolitical shocks. Strategic asset allocation is a key governance principle. We talked about the importance of governance this morning, and that's in alignment with LACERA's long-term obligations. Market timing may be the first cousin of strategic asset allocation, and this is something that Tim Phillip talked about at the offsite during the macro session, that patience over prediction, that resisting the urge to chase trends or retreat from volatility has paid off for LACERA. So number 2 is investment beliefs, that LACERA's investment beliefs have been elevated to our investment policy statement. They guide our allocation, our implementation, our liquidity profile, and our risk posture. Our investment beliefs are durable, and I think that durability has really done something important in that it has allowed us to bridge tenures, with the board and staff and foster stability as there's always turnover with staff and with the board. And maybe the 3rd theme, as identified by Microsoft Copilot, is the pension versus OPEB. It's 1 board, 1 team, yet 2 mandates. We have distinct investment objectives for LACERA's pension and OPEB trusts, and there are differences in the returns. The pension and OPEB have different return profiles and implementations, and that's a function of asset allocation, liquidity profiles, and risk tolerances of the 2 plans. And the final thought is one on a lighter note. I mentioned to Jude I had something special planned for today. He thought I was going to give notice, but that didn't happen. The final thought is that we didn't get to $100 billion, and this is serious, in AUM by my 100th Board of Investments meeting, but the liabilities of the pension and the OPEB have. And I think that's a really important thing because the magnitude of our liabilities, really grounds our approach. And I think that keeps us hungry and humble at the same time. So with that, Mr. Chair, I'm happy to stand for questions.
Ms. Mee?
Thank you, and thank you for the report, Mr. Graver. I enjoyed listening to the whole report. So I have a question that happened to be on this slide. I'm glad that you talk about credit. So that's actually that I want to ask about the credit. And you also touched upon these 2 fund, OPEB fund and then the pension fund. They are managed in slightly different, right, with the different objectives. So what I noticed here is that OPEB for the credit, for the 1 year, 2 year, 1 year, 3 years, 5 years, they all performance seem to be below benchmark. In comparison to our pension fund, we're doing really, really, really good there, that we're exceeding the benchmark for all the 1 year, 3 years, 5 years returns. So could you give me a high-level explanation of how we manage credit differently in these 2 funds that will result different in the performance?
Sure, and thank you for the question. For the pension, the credit portfolio is more evolved in that the implementation started sooner, and it is more a hybrid between both private credit and more, I hate to use the word public credit, but more credit instruments such as bank loans and high yield, things that trade more frequently. OPEB is more the latter. OPEB is concentrated within bank loans and high yield, and the implementation of private credit mandates or illiquid credit is more nascent. So I think that the difference in implementation accounts for the differences in the return profiles and the performance.
Thank you. Do you see there's something that we can do to improve the credit performance in this fund to meet closer to the benchmark?
For the OPEB trust, the board approved several years ago the implementation of a private mandate, and that is in the implementation stage, but it's newer. Whereas for the pension, we started that implementation for credit as a discrete asset category in 2019 or so. However, and this was, I think, discussed at the offsite, at the time, credit in the pension existed in 4 different asset categories. It was in our hedge fund portfolio, it was in our fixed income portfolio, it was in our private equity portfolio, and it was in our real estate portfolio. So it was pre-populated with more private investments at the time. So it now it's since evolved and has been re-implemented, but it was some of the more better risk-adjusted return options were already in the credit implementation for the pension versus OPEB. OPEB is a newer credit, so it's more de novo, and it will take time to get closer to where the pension is.
Thank you. So I appreciate the explanation, help me understand the two fund, how it manages differently, better today. I shared in the past meeting that this is the I believe this is my 20th board meeting, a second year. So from a year and 10 months ago, I didn't know anything about our pension fund, how the portfolio is being managed, until today, that I gain more and more confidence and conviction every day, that I can tell the members that I think we're managing it properly, we're doing a great job, we're doing everything, that in our best capacity. So however, I'm thinking as a organization, we pride ourselves as a learning organization. I think it's important that we continue to do self-assessment, what we're doing good, what the areas that we can improve from, and then the peer, how are the peers that doing the similar pension fund in the nation, and what we can learn from other pension fund as well. So with that thought in my head, I've been reading news about other pension fund here and there, but it's just piece and piece information coming in. So I have a request, I think this request may be more suitable to our consultant, Makita. I'd like to have a report, for the fiscal year ending by June. In this nation, similar pension fund, how are the pension fund doing in terms of their return and risk-adjusted return? So that it help us, to understand even one step further, where we're at, and then what learning that we can do, and then how other pension funds are doing out there. So maybe this can be added to next meeting's agenda, just a high-level report, how are the pension fund doing similar to our pension fund.
Just if I can, through the chair, we produce, and I think it may be quarterly performance reports for the full fund and OPEB, and there's one from staff and one from Makita. The request, can we just put that material in that quarterly report such that it's that way it's in sequence with how we report information? Oh, the peer rankings are in there, actually. In the Makita, is it in Makita? So is it in last month's?
It's only in the quarterlies.
But was it in last month's quarterly report? So it was in last month's material that went to the Board of Investments. We can pull it out and resend it if that's helpful.
Be very helpful. I must miss it. Yeah. Thank you.
Anybody else? Well, Mr. Grable, congratulations on, oh, sorry, Mr. Scott, I didn't see you.
So, I keep harkening back to, there was that really famous report that came out right after the GFC. It was put out by Merrill Lynch, and it said something very similar to what you said today, which is when all assets are correlating, that's a big warning sign. right before the big crashes of 2006, 7, and 8, I just remember that everything just started marching in unison, right? It was like gold, real estate, all things that are supposed to not be correlated. So I guess the question is, and I'm one of the questions that, like, I think I know the answer. The other one I'm just really curious about, which is, would a pension like this, would we ever get to a point where the returns got so strangely excessive, or that everything was so correlated that it was time to push a panic button in a weird way, right? The returns are too high, right? I mean, like, this seems like it's a little too frothy. And I guess the other question is, for these smaller pension funds, for the more nimble pension funds, the ones that are more, can be more actively managed, are you aware of any of our, county counterparts? Are any of them taking bold moves to go like mostly to cash or anything like that? Does anybody do that these days anymore? Is there anything like that? Where are there any that are run by an eccentric enough manager, right, who says like, you know what, I've seen enough, like I'm pressing the button and we're going mostly to cash? Right?
2 questions. The first one relates to the panic button of sorts, that question. And LACERA did of sorts, not because things were too good, but were too bad. In 2008, during the GFC, LACERA backed out of private equity, saying, you know what, the market's down 40%. The pension major draw were concerned, and we skipped a full vintage year plus and made no private equity commitments and missed the best vintage year in a generation in terms of private equity returns, because LACERA wasn't alone. And that just created, once again, you get back to market fundamentals, scarcity of capital. The capital was able to have economic rents. So it hasn't worked well for LACERA. And I think that the challenge is, if we're investing for generations, to be consistently correct and ask the plan sponsor and members to, in effect, subsidize if we guess wrong. I think that that's just a hard thing for us to do. So I think our natural approach has been, we'll consistently be strategic, and by being strategic with a target allocation and revisiting that every 3 years, that's both offensive and defense, both strategic and tactical at the same time. So we haven't done it. I don't know. There are investors that do it, those that do it right. And there were a lot during the GFC, during Brexit, you name it, during COVID, that raised their hands and say, we got it right. You don't see the people who got it wrong. They don't go on Bloomberg or CNBC and say, yeah, I was precisely wrong. So it's somewhat self-selecting, self-editing, because many of them may be out of business. As it relates to outlier, I know of plans that were early adopters that put significant amounts in Bitcoin. I know of some that have higher cash. I know of some, but I don't have enough data to benchmark how their returns are over time. And I think it's something that Ms. Mee requested and pointed out a board meeting or 2 ago, which is related to the Sharpe ratio, that, last fiscal year, we didn't necessarily have the highest return, but our Sharpe ratio was top decile. And so that have a really efficient pension. And one other way to think about it is, if global equity over the last 3 years has compounded 22%, we've been rebalancing out of that consistently. So that 22% profit has been funding other things, and other things that are performing differently. And when we need them most, that's when we'll need them. which is a kind of a truism. And as the board chair has said multiple times, in fiscal 22-23, when we had a down year, we were marginally up because we remained diversified. So I don't know if I kind of, those are some flavors. I don't know if I answered it or just filibustered.
No, I mean, I hear you. I know it's largely, not something that would be credible for, major pension fund to do. I was just curious if at ever point, for example, if the conditions just remarkably mirrored the, past times where things have been just so frothy that it seems, with the benefit of hindsight, as you said, to be just apparent that we're due for something. If it would be worth maybe scheduling like an earlier point for the board to consider a rebalance in our strategic allocation. It just would that ever happen, right? And I could imagine a scenario where things just seem so correlated, and so where we're really not that diversified because the major categories are so correlated, they're marching in lockstep. And if that's the case, I think it might be worth discussing.
And through the chair, in the investment policy statement, the board has the right, obviously the board always has the right, but it's stated the board does its strategic asset allocation every 3-ish years, but can do it sooner based upon market conditions. And I think the closest we've come to that was during COVID, where we typically do structural reviews every 3 years. We did a mid-cycle structure review of every asset category during COVID to say, what's happening? Have things fundamentally changed so much that we need to change our implementation? We didn't do it for the allocation, but we did it for the implementation. And so the board, I think, was nimble at the time. And I think it's really important that we be structured and deliberate, yet mindful of the context and the environment that we're in. So I appreciate the question.
Anybody else?
Just the last thing to close the loop on that, I would be in favor of doing a light, like adding to the agenda for a meeting in the next couple months, something where we just get the data on how correlated the various major assets in the main fund are, and just have a brief discussion of whether it's worth doing the full discussion, if that makes sense.
I believe one of our consultant reports has a complete breakdown of individual funds within asset categories. Is that correct?
Mr. Chair, so the consultants reports every year we do a capital markets expectations refresh that typically gets published in February. So that goes across 100+ different asset categories. It reviews summaries of assumptions for expected returns, but also updated correlation matrices. So I would suggest if we wanted to look at that, we would use that February meeting time when that full deck is available. As we see it for this year, our CMEs will likely produce lower return expectations than in the past because of the valuation appreciation that we've seen. There hasn't been dramatic changes in the correlation matrix because those typically tend to be 5 and 10 year or longer that we're looking at. But we could shorten some of that time frame and add some additional analysis to it. It is a very comprehensive exercise to do, let's say, out of schedule.
Yeah.
So I would suggest February if we think that could, but we could certainly, it wouldn't be hard to run a major.
Yeah, and I want to balance my request with the clarity that I'm not asking for, the full thing, because I know that's a lot of work. It would be helpful though to get some kind of data perhaps out of the February cycle that is also not looking back 5 years and 10 years, but perhaps a shorter window, right? Because it's really that last moment, right, where everything starts to send these flashing signals, right? So I would just be, it would be helpful to me if we could somehow get, it doesn't need to necessarily come from within that structure, but some kind of data for like, 2025, like, just 2025, like where things are marching in lockstep and, what is still an uncorrelated asset if such a thing exists. And just, again, informally, not a lot of data, not a lot of work. I don't want to create a lot of work for you or for the staff. But I think that data would be helpful to get before February.
Could we just tag on to the February 25 report? And is that something that would be doable?
I think Mr. Gatto was asking for something earlier,
Earlier than
February.
No,
Yeah.
no, not February 26th. That's when Tim's report comes out. I'm talking about, we have a February 25 that came out this year. That would be that short
Yeah,
calendar.
we can work
window.
with staff on coming up with a correlation table that's.
That's a good
shorter
framework to
time
start, right?
frames. It's probably not going to be as detailed on all the different asset categories. And in particular, you're going to have to exclude private markets because that data is going to really skew it and be hyper lagged and a whole bunch of other stuff. But we could certainly look at most of the public categories
Yeah,
over a shorter time frame and just have 2 or 3 charts that kind of highlight that.
for sure. And I'll look too. Look, if something's publicly available, then
Yeah.
you don't have to. I'll try to find it myself too. But I think it would be helpful just to inform us as we enter these very sort of uncertain times.
Mr. Grable?
Through the chair, just to set expectations, November is probably difficult given that the November materials are basically being polished at this point. I'd say that December, just to set expectations.
Yeah, and if that works, if that's something we can use, Tim, as a framework or a starting point, that would cover a 10-month spread and trying to identify that trend. Ms. Mee, you have an additional comment?
Yes, I just want to join the discussion. Excellent discussion here. Like Mr. Graver said earlier, our job is to worry. We get paid to worry. So we should be worried about all the uncertainty in the current economic environment. So is that a potentially recession happening with the job, right? Employment situation, inflation, tariff, everything like that. So it is something that we should be worried about. So maybe in that light, assessing what's, just to help us to have the reassurance about current asset allocation, are we going to be okay if we're facing a recession? The current asset allocation. I know that's our strength. We set up for long-term success. We set up our strategic asset allocation for such a scenario as well. I remember back in the discussion, but just look at today's environment. How we will be doing. We will be okay if there's a recession.
All right, thank you. So just addressing some of the comments, as large as we are, if we're baking a cake, everybody's eating it because it tastes really good. We have weathered, significant market downturn in the last, 3-4 years. That is a testament to the recipe that's in that cake. There's, incredible diversity. The asset reallocation in my short time here on the board has been producing, And I think that, I agree that, any information and any data is always, but there is no crystal ball, as Mr. Grable said, and we have to look at past events and, history repeats itself. I do agree with that. But, I want to talk about like slide 21 as an example. When we talk about our fiduciary position increasing, it's very telling. You look at fiscal year 24, we increased our net position just over 5 billion. Fiscal year 25, 7, and then we're at $500 million, and we're not even through the second quarter of the fiscal year. So, and then looking at our position, as it comes in, we are strongly, with the exception of a couple months here, but we are strongly outpacing our benefits, refunds, and the cost of doing business with our fees. And I need to highlight that, that, you know, there is no crystal ball, but I think with the structure of our fund and the management of it here at LACERA seems to be consistently hitting our internal benchmarks. And I think that we need to really have a lot of trust in that. I'm confident in it, and I say good work to you all and keep doing it. So, but yeah, any information, as long as it's not too labor intensive for staff at the year close. So a couple of things. Mr. Grable, congrats on your 100 meetings, right? I'm not keeping count. I'm trying to forget. So, also your appointment to CFA. I think that that's really great to be recognized in that, and being able to share your knowledge and your philosophies and your you know, your I lost my train of thought, darn it. Your posture, you know, and how, you know, your leadership skills, your personality. I mean, that, I think that's important, and it's really a great thing. I'm glad you got that, and I hope it doesn't fill your plate up too much. So, staff chart of the month. Look at the trend here. We got early career. The 20-somethings are not getting into computer programming. We have an aging tech force. I blame TikTok and Instagram. I think everybody wants to be an influencer, including myself. But yeah, it's interesting. And I wonder what goes into this data, if AI is contributed to that. You know, I know a lot of AI platforms are helping write code, and it's kind of it makes it easy, you know. I mean, I guess, I don't know. I'm gonna start writing code. But yeah, so thanks for including that. Anything else from anybody? Thank you, Mr. Grable. Going on, it was a member spotlight.
Thank you very much, Mr. Chair. Good morning, trustees. The member spotlight is a way for LACERA to recognize the public servants who care for the constituents of LA County. It's also an opportunity for us to reflect on why we do what we do as we serve our members and empower them to live and enjoy a healthy and secure retirement. So this month, we recognize Stephanie Zumbo, who is a Compton courthouse reporter. She has retired after 30 years of service and through a variety of courts. Her proudest accomplishment is her growth in her career, and looking at the number of different types of courts that she served in. Her ability to get through all of that, understand it, and be accurate is incredibly important, and she certainly did that. Her life's heroes were her parents, who instilled in her hard work and accountability as values. I think one of those sounds pretty familiar. Accountability is one of our values. And her firefighter husband. So that's a family of civil servants. And so by extension, we also thank him for his service. So thank you very much, Stephanie, for your service to the county. We appreciate you.
Thank you very much. And Chief CEO report, please.
Yes, good morning, trustee or Chair Green, trustees. We're going to have the CEO report pulled up. As you can see, for this month, we have reimagined CEO reports. I want to thank Bonnie Nolly and the team for putting the report together. In the interest of time, I'm going to jump to slide 6. If there's any specific areas that the trustees want me to touch on the CEO report, I'm happy to do so. But I want to jump to slide 6 as it relates to our, slide 5, my apologies. And I just want to highlight our current focus, our strategic focus around our hiring. If we can go to the vacancy rate, prior slide, please. So I just want to focus on, again, this is a strategic initiative that we have as it relates to our workforce. Vacancy rate is a pulse check for us. It signifies organizational agility, our workforce management, and obviously our nimbleness to get talent on board. We're currently operating at 17%. As you can see, we do not have a benchmark goal. The Society of Human Resource Management, which is a global HR association, doesn't particularly highlight any specific goals around vacancy rate. They really have the industry focus, the organization focus on their industry. They do spotlight a 5 to 7% range in terms of really having a healthy vacancy rate for organizations. For us, last year in 2024, the National Council, NCPERS, National Council on Public Employee Retirement Systems, did a compensation survey, and vacancy as well as retention was a high point of emphasis in that survey, but not a single system highlighted kind of their vacancy rate goal. So it isn't a benchmark within our industry. So we're going to continue to look around to see what makes sense for us at LACERA. I would say under 10%. That's my kind of commitment now. And we're directionally, that's our focus, is to continue to lower that rate. One of the things we highlighted with the BOR last week is as we see vacancies, for us is a little unique because we don't want to just backfill. We want to look at the classification. We want to make sure that that vacancy supports the future need of the organization and where we're headed as it relates to our strategic priorities. So this will be a snapshot that we'll highlight monthly, and it'll probably be some refinement, but want to make sure we called that out.
Hey, Louis, by the way, I've been here long enough to remember when it was in the low 20s. So seeing the progress down to 17, I don't know what the structural rate of vacancy is, whether it's 10% or below or not, but just, you know, a 4 or 5% move over the arc of time is to be acknowledged. So thank you.
Definitely. Appreciate that. And then next slide, please. Just current recruitment activity and additions to the team. Want to again congratulate those individuals internally and also externally that have onboarded and to our team, as well as our current recruitments underway. So with that, Chair Green, I'll stand for any questions.
Thank you. Anyone? All right, thank you for the report. Moving on to item 7, consent item 7A, super return. We need a motion to adopt it.
Second.
Okay, Ms. Proft?
Aye.
Ms. Me?
Aye.
Thank you. Mr. Green?
Aye.
Mr. Rue?
Yes.
Mr. Gatto? Mr. Jones?
Aye.
And Ms. Langton? Okay, the motion passes unanimously.
Great. Moving on to item 8A, non-consent items. We have a recommendation and a presentation, don't we?
Yeah.
Good morning, Mr. Chair and trustees.
Good morning.
Kwok and I are here to discuss an update to the manager diversification guideline in our hedge fund portfolio, which, as you know, is part of LACERA's risk reduction and mitigation functional asset category. Guidelines are a risk management tool, and they evolve along with the portfolio objectives as governed by our strategic asset allocation and asset category structure reviews. A comprehensive review of guidelines is currently conducted every 3 years as part of the structure review, but occasionally changes to specific guidelines are recommended within the triennial review cycle, and that's the case today with the manager diversification guideline. This guideline originated from the 2019 structure review when trustees approved transitioning from a fund of funds implementation to a direct program. At the time, LACERA's hedge fund program consisted of 2 fund of funds, which together invested in more than 60 individual hedge funds. The transition to a direct program was driven by a desire to construct a more intentional portfolio that also offers greater transparency and lower costs with many fewer managers. So that's how we arrived at the existing guideline of approximately 10. The transition to a direct portfolio was completed a few years ago, and today, both the direct hedge fund program and the emerging hedge fund manager program are well established, as we'll see in the next 2 pages. Therefore, limiting the percentage allocation to a single manager is a more effective way to manage risk than a guideline based on the number of managers. The pie chart on this page shows the manager percentage allocations for the direct program. As a reminder, the program's objectives include enhancing the total funds diversification by having low sensitivity to major markets and providing downside protection. The 11 managers shown on this page as a group delivered frequently positive returns with very low volatility. Changing the focus of the manager diversification guideline from manager count to percentage allocation would enable LACERA to further diversify the hedge fund portfolio by incorporating complementary exposures, including relatively niche strategies and emerging manager graduations, while remaining aligned with overall objectives. Additionally, this manager diversification framework is consistent with the approach used in other LACERA asset categories such as growth and real assets. This page shows similar information for the hedge fund emerging manager program. Again, we show a pie chart with 10 managers showing their percentage allocations. The program started in late 2021, and we anticipate continuing to add managers as the program is currently below its target weight. As new managers are added, the percentage allocations of existing managers would decrease, whereas any manager graduations or terminations would lead to increased percentage allocations for existing managers. In summary, as shown on this page and highlighted in the dotted lines, the proposed modification is to change the manager diversification guideline from a manager count of approximately 10 to a percentage allocation maximum of 20%. That's 20% each for the direct portfolio and the emerging manager portfolio. Before I conclude, I'll note that Allborn's support memo is included in the package as attachment 2. That concludes our prepared remarks. We're happy to take questions.
I have a quick question. The reallocation of assets and I support this. I think percentage-based stuff works. It increases flexibility, right? And it's up to 20%, which is great. You know, in the asset reallocation, how quickly does these managers move? So, meaning that, you know, we talked about that rebalancing, that equilibrium. You know, try to, you know, increasing the size of the number of managers, spreading out based off percentages, right? So how quickly would that, just out of curiosity, would that only be happening during asset reallocation, or is that something that if some managers kicking butt out there and right, and then you want to reallocate it at that time, can you explain that process a little bit? The speed of it. And
the manager allocations are always changing based on relative performance. So that's happening month to month. But the big moves occur when we add a new manager or we increase an allocation to a manager.
During our asset reallocation process, right? Like,
right.
Yeah.
As I mentioned, for example, in the emerging manager program, we're currently underweight. So if we allocate, let's say, $100 million to a new manager, that's going to be wedged into that pie chart. So all the other manager percentage allocations will come down.
Gotcha. Yeah, because it's 20% per manager, right? Correct.
Yes.
And whatever it's structured within the fund. Yeah, got it. The percentage of what it is in the fund, 20% of what. Yeah, excellent. Thanks for clarifying that. And it can happen monthly if, you know, somebody's out there, the pursuit of alpha, right? They're really ripping it, and then you can move right then.
That's right.
Yeah, that's great. I support it. Looking for a motion, Mr. Root.
Oh, I had a quick question. What's the total fund amount for the hedge fund and then the emerging manager hedge fund? Both total fund amount we're talking about?
Emerging manager portfolios somewhere just under 700 million. Is that right? Paul?
Right.
About 700 million. So basically linear B at 17.7% will be 17.7% of that 700 million.
Yes.
And what about for the the direct hedge fund portfolio?
It's about 6.1 or 6.2 billion.
Okay, 6.2 billion. In the future reports, just minor thing, if you could notate that somewhere, because I couldn't find it anywhere.
Sure. Happy to do that.
I'll make the motion.
I'll second it.
Thank you.
Okay. Ms. Proft, Ms. Me,
Aye.
thank you, Mr. Green,
Aye.
Mr. Rue,
Yes.
Mr. Gatto, Mr. Jones,
Aye.
and Ms. Langton. Aye. Okay, the motion passes unanimously.
I'm sorry, please go ahead with 8B when you're ready.
All right. Good morning again. This proposal is very similar to the preceding agenda item. We recommend changing the manager diversification guideline for credit from a manager count measure to a percentage allocation measure, as we believe this is a more meaningful and effective risk measure. As discussed at the board offsite during last month's meeting, LACERA's credit portfolio's objectives and structure have evolved considerably since the functional asset category was created in 2018. For example, the most recent structural change was the consolidation of liquid and illiquid credit, which occurred last year following the adoption of a new SAA, Strategic Asset Allocation, in April 2024, and new benchmarks in May of 2024. Given this consolidation, moving away from a manager count to a percentage allocation guideline is advisable. This adjustment would provide a more effective way to manage risk than a guideline based on the number of managers. It would also enable LACERA to incorporate complementary exposures within the credit portfolio, including relatively niche strategies, emerging manager program graduations, expanded geographic coverage, and other approaches while remaining aligned with overall objectives. Also, as noted earlier, this approach is consistent with the way that other LACERA asset categories address manager diversification. The pie chart on this page shows the credit portfolio's manager allocations. As a reminder, the target allocation to credit is 13% of the portfolio, and that's roughly around $10 billion right now. The part in blue represents the multi-strategy mandates, and the portion in green contains the legacy and the discrete sector mandates that are currently under review. 2 points are worth highlighting. First, recently hired managers such as Singular Guff, Onyx, and Centerbridge are in their ramp-up phase and will be calling capital, so their percentage allocations will increase relative to the managers that are fully invested. Second, Magnetar's allocation is currently above the 20% threshold. As discussed with trustees in June of this year, this is a temporary situation which will be resolved in the coming quarters. This page shows similar information for the Credit Emerging Manager Program. This program is still relatively new, having made its first manager selection in November of 2022. As shown in the pie chart, several managers have been hired since, and we anticipate further additions in the near future. As new managers come on board, the percentage allocations to existing managers, most notably the 3 emerging managers near the 20% limit, Kenai, Phoenix, and Harborview, those percentage allocations will decline. In summary, as shown on this page, the proposed modification is to change the manager diversification guideline from a manager count of approximately 10 to a percentage allocation maximum of 20%. And again, that's 20% each for the direct portfolio and the emerging manager portfolio. Once again, I'll point out that Allborn's concurrence memo for this recommendation is included in the package as attachment 2. That concludes our prepared remarks. Happy to take questions.
Ms. Me?
Thank you. Thank you for the presentation. I fully support this because I was thinking similarly when I was looking at private equity. At one point, I believe I asked a question in closed session when we have allocation to a single manager and the dollar amount seemed to be really high. I asked that question in the private equity deal there. Was there any concern with that, concentration to one manager? Maybe perhaps private equity is different from here, but I'm glad to see we put a limit to a single manager's, allocation here. So it's the right, similar to my concern. So I'm happy to see that. My question would be that 20%, I didn't ask for the hedge fund earlier, I asked it here because the credit allocation is much higher. Like you said earlier, Bill, I believe we have more than $10 billion allocation to credit, right? So that means that 20% of 10 billion, that means that one manager can have allocation up to $2 billion. So I don't understand that meaning of a $2 billion per manager as good as probably you guys understand. So help me here. How did you come to the 20%? Is it the art, is it science, or is it practice out there? Is it the 2 billion maximum per single manager? Is it too high? Maybe my understanding is different. It seemed too high to me, 2 billion one manager.
20% is a maximum. We expect to be considerably below that. Let's set aside this one exception. We expect to be somewhere in the 15 to 20% range for our largest allocations. We think it's prudent not to go above 20%, but I'll just point out that in other asset categories, such as real estate, real assets, and global equity, we have even higher maximums. I think in core real estate, the maximum is 35%. In non-core real estate, it's 30%. In real assets, I believe it's 30%. So we think 20% is prudent, but we don't expect to be at that 20% limit. We expect to be below most of the time.
20% providing a flexibility, a cushion, but targetly we will operate it a little bit below that, correct?
That's right.
So also for the future, I'm thinking now we are 86 billion pension fund in the future. As we get bigger and bigger, the total fund, when it get larger, that 20% might means different absolute number by then. So I would assume we're going to revisit this 20% maximum in the future when our fund got bigger, right?
We will revisit it on an ongoing basis. I wouldn't say that it's tied to the absolute dollar amount, but I think it's good practice to revisit it periodically. The other thing I'll mention is that as the fund grows, as I mentioned in my notes, my prepared remarks, we'll look to add complementary exposures, perhaps more niche strategies, perhaps more geographic diversification. And by adding those, the percentage allocation to existing managers will necessarily come down.
Thank you so much.
I appreciate the question and concern. To simplify what I understand about this, Mr. Graber, I'll call you in a sec. I just wanted to point something out, that one of the key points of this is that instead of being bound just by 10 managers that could get like thinking together and possibly create jeopardy for our fund because there's only 10 of them, this now with the new target up to 20% allows for it creates agility for LACERA to increase their slice of managers to look at and allocate those funds, whatever's allocated in credit, for example, to spread it out if necessary. and up to 20%, you know, it's, so I appreciate the concern, but I think that this is really a benefit. You know, getting away from a set number of managers and maybe a corner of the market as this credit, you know, credit grows globally. Mr. Grable?
Thank you, Mr. Chair. Just in terms of the thought process, if that's helpful for the board, is the existing guideline really wasn't a guideline. It was a direction. It was, you know, we were at, in the case of hedge funds, we were at 60 plus. Credit also had fund of funds and lots of different managers. So it was a directional move of the board to say we're going to go from too many managers to a more concentrated, more deliberate type of implementation. One of the things that we look at is we never want to set a guideline that we're immediately breach. So we're kind of at 20-ish right now. And the 20 also is more conservative, more of a risk control, as Vache mentioned, as other asset categories, which are 30%. So we wanted to tighten the guideline, recognizing the concentration that does exist, you know, towards Ms. Mee's point about that $2 billion mark. But once again, we never want to have a guideline that day one we're in violation of.
Yeah, thanks for addressing that. And Ms. Mee, that's a good question. Mr. Ryu?
So thank you. What's the amounts again for the emerging managers and then the direct credit portfolio? Total dollar amounts?
Squawk has those numbers.
Yeah, so the credit portfolio is roughly 10.5 billion. And the emerging manager program is roughly 500 million.
Okay, so this example actually, I was trying to wrap my head around it in the previous presentation, but I get what you're trying to do now here, because especially now that in the credit portion, there's single managers that have more than 20%. So it's a 20% max, but are you still trying to target or have more than 10 managers per category? Or because technically you could have 5 managers at 20%, right? So the number will go down. I
think this transition from manager count to a maximum is a more effective way to risk manage the portfolio. If we kept at this pace and kept the guideline of 10, since I've been here, for example, the hedge fund portfolio went from 3% of the total fund to 4% over the next strategic asset allocation of 6% to 8%. If we kept it at 10 managers, those based just on the denominator, the dollar size of each mandate would grow. This maximum of 20% of the portfolio allows for us to continue to add exposures to the program that, you know, obviously fit the objectives of the program, but then also reduce the denominators of all the other managers so that they're not a larger share of the program versus being capped at like a 10% number of managers for the entire portfolio.
Well, because for the, I don't want to go back to the previous one. For the hedge fund, previous one, there was more than one of them. One of the categories had more than 10, but for the credit side, they're all under 10. So you have,
so
I think there's 9 in the credit and there's about 7 in the emerging managers, right? So,
right. So for this one, for the credit portfolio, there are the 7 here that you see.
Mhm.
And then in the note, we do mention that there are a number of mandates that make up of that green slice. Those are more legacy and discrete mandates. And those are made up of 16 individual mandates within that slice right there. So, but those are the more legacy mandates that we are either winding down or reviewing as part of prior board approved structure reviews. And then for the emerging manager program, it is a smaller count at the moment, but it's an early program and that's intended to grow over time.
Mr. Grable?
To build on what Kwok's answer, the goal still is to have a concentrated, very deliberate implementation, recognizing if we limit the count of business partners, there may be more niche opportunities that we can't add to the portfolio because we're up against the cap. So, but the goal still is to have a concentrated portfolio where we are term makers, we have pricing power, and that we're more strategic, have more strategic relationships. But the goal ultimately is to retain a very deliberate type of implementation.
And you also said earlier that you don't want to start off with everybody being violating your protocol, because obviously for the hedge fund, no one is above 20, right? But then for the credit, it looks like it's just Magnetar and and there's a few and Kane and a few reaching the 20. So I guess you start with the 20 and then will you reevaluate to see if you want to go lower? Or
the guidelines go back to the board subsequent to the strategic asset allocation. We do structure review. So every 3 years, guidelines go back to the board. So that's something that all guidelines can be evaluated once again every 3 years.
And David, I think with the other president, the violation is exceeding the 10 managers. Don't exceed 10 managers in the credit. Part of the reason is because it's newer, but in the other portfolio, that's where we're violating the policy.
Right.
So
yeah, no, yeah, love to see how it works out. Yeah, but I agree with the concept. Yeah, we should not limit ourselves to 10. I just feel like when you say 20%, I just feel like we're going to shrink instead of get larger.
Yeah, I
But
can assure you that's not the intent. We don't intend to have
Right.
5 managers at 20%
Yeah.
allocation each. There will be more than what you see here
Right.
in the blue. And Magnetar is an aberration. You can see the next highest is 13.5. Once this temporary situation is resolved, we think they'll all be in that same neighborhood.
yeah, it creates competition because we're not limited by a number. I mean, and
Yeah.
and performance-based return, we should be able to reach out. And I think this is great. You guys are staying relative. I mean, as the market changes and equilibrium is found and lost, we have to keep up with it. And as you said, that as far as starting out, there's 1%, 2%, and we're keeping up with the Joneses and staying relative. And we have to be agile. And kudos to all you for paying attention to that and making this a priority to help give our fund room to grow where it's going to grow, right? So I'll move to adopt staff recommendation. Looking for a second.
Yes, I
Okay.
Second it.
Ms. Croft? Aye. Ms. Me? Ms. Me?
Hi, sorry.
Mr. Green?
Aye.
Mr. Rue?
Aye.
Mr. Gatto? Ms. Martinez? Mr. Jones?
Aye.
And Ms. Langton? Okay.
Mr. Chair, is it appropriate to make a comment or are we closed?
No,
Yeah,
please
just,
feel free.
yeah, I just wanted to make it clear. I like the diversification and I wanted to make sure that we have a lot more managers. It's just that the percentage got me confused. But especially for the emerging managers program, love for it to get more robust because that's the entry point. And obviously, but at the same time, of course, those who are doing well, we don't want to hinder them as well. So, but I know you guys have thought this well through, but I appreciate the fact that it's more about diversification. Thank you.
Thanks, you guys. All right, moving on. What time we got here?
10:15.
10:15. Is it, if you guys are okay, we take just a 10-minute break to stretch our legs and whatnot before we get into the economic actuary report and assumption review. Let's be back here and at 10:30. What do you think about the information?
Go ahead.
Huh?
Nothing. There's no presentation.
Pulled one?
Mm-mm.
Oh. Going with 9A. Mr. Coyer and Mr. Granger have a presentation. Craig's not with you today?
That is correct.
Excellent. All right. Please go ahead.
Off is on. Wait a second.
All right. Good morning, Chair Green and Board of Investment Trustees. My name is Ted Granger. I'm the Chief Financial Officer here at LACERA. My team is responsible for coordinating the actuarial services. With me today is Nick Collier. He's a principal and consulting actuary with Milliman. He's one of our lead pension consultants. Craig's not here today. Craig was feeling a little bit under the weather, so we decided to give him a little bit of a break for this particular session, but there'll be plenty of time for Craig to address the board in future meetings. I want to thank Melissa for driving the slides for us today. If we could go to slide 2, please. Okay, so a quick overview of the presentation. I will provide some overview, a little bit of background. I'll talk a little bit about the 2025 actual projects. There's a roadmap slide I'll talk through, and then Nick is going to present. He's going to dive right into the economic assumptions. So we're here today because of Searle and the board's actuarial funding policy. Those both of those require that LACERA's consulting actuary Milliman perform an experience study every 3 years. The last time we did this was for June 30, 2022. This is for the June 30, 2025 cycle. An experience study is when Milliman reviews the economic and non-economic or demographic assumptions. They look at the experience over the last 3 years in terms of what actually happened and compare it to what was expected to happen. Then Milliman recommends changes perhaps to the assumptions as needed. At last month's BOI offsite, we sort of kicked this presentation off, or this cycle off, by providing the overview of the experience study. Milliman went through about 90 minutes worth of slides. We also had the economic person from Milliman, Alan Perry, present. So that really served as the background for this discussion today. So this discussion is going to be a little bit more abbreviated or sort of condensed. And as you'll see, Nick's going to get right to the point. Be sure to ask questions along the way. We encourage questions. Nick is here to address and provide the information necessary. Nick is looking for feedback on the economic assumptions as he starts to prepare the experience study report, and I'll talk about that when that report will come to the board here in just a second. So again, Nick is looking for any feedback, any questions on the assumptions he'll discuss today. Very quickly, I'll move to slide 3, please. Quick snapshot. Obviously, the Board of Investment offsite was in September. Today in October, we're going to talk about the economic assumptions. We're going to skip November, and we're going to come back to the board in December, where we have a couple of items. We have the demographic assumptions that'll be discussed at that time. Milliman will have an experience study report that'll provide the results of the experience study, both on the economic side and on the demographic side. One thing I didn't put on the slide that I sort of overlooked is that Kavanaugh McDonald will also be here in December, and they will talk about their review of the experience study. So just as a quick reminder to the board in terms of the cycle, every 3rd year, Kavanaugh McDonald Consulting comes in, CavMac. There are actuarial auditors, if you will. It's a separate consulting firm. They review Nick's and Milliman's work on the experience study, and they also review the actual evaluation. And so they'll be talking about the experience study in December. Fast forward to February and March, Nick will have the valuation report that'll provide the funding metrics as well as the update to the contribution rates. And of course, CavMac will come in and talk about the audit report of the valuation as well. For my team in April and May, we'll work with the Board of Supervisors to get the contribution rates updated. And I'll make a quick note on that. For this particular cycle, because we're in the triennial cycle, the 3rd year, all of the contribution rates are up for renewal or update, if you will. The legacy plans, the PEPR plans for members, as well as the employer rates. So this is the triennial year where all of the rates are updated. Just wanted to make a note of that. On an annual basis, it's only the PEPR and the employer. So, and then finally, as far as the timeline goes, in June, In summertime, Nick and Craig will come back to the board and talk about risk and based on the results of this valuation, but that's a little bit later state. Any questions so far on the timeline or the overview?
Yes, please. On the annual, we know that PEPRA as the annual increase and the employer matches that at 50-50 for the funded liability.
Yes.
Is that strictly PEPRA only, or are they accounting for potential changes when the triennial hits also in that cut?
Well, I think what you're getting at is the triennial, if assumptions are adopted, that will affect what the total amount is. It'll still be a 50-50 split, but depending on what assumptions are adopted, it will ultimately impact what the contributions are.
Yeah, right. So the timing of it is every annual for all PEPRA employees, there's increase or decrease in contribution by the employee and the employer, but specifically just for post-PEPRA employees. When the triennial hits, right, it's
all employees.
It's all hands, and thank you.
That's correct.
Yeah, so maybe another way to say it is the assumptions are set for the next 3 years for the entire plan. PEPRA is tracked each year where they're adjusted based on the most recent assumptions that were adopted by the board. Did I get that right, Nick?
Yep.
Okay. Okay, great. Okay, if there are not any other questions, I'm going to hand it over to Nick. If we could move to slide 5, please.
Yeah, so obviously, Craig sends his regrets that we're one short of our actual quota of actuaries, but hopefully I can convey what he would have said, and hopefully I will, as Ted said, we'll get to the point. He's already talked about this slide. I just would highlight a couple things. Obviously, one thing is this is, in our view, a very quiet time as far as our recommendations. We don't on the economic side for sure. We're not recommending any significant changes, but we're always looking for the board's feedback. We don't claim to be the experts on economic assumptions. And obviously those will flow through to the actual evaluation. At the December meeting, if there are any outstanding questions, so if the board wanted us to look into something, we could do that, and we could have a follow-up at the December meeting. All right, so next slide, please. When you think about the assumptions, obviously economic assumptions are projecting, what the assets are going to earn. So how much your investment earnings going forward. They also help project the benefit payments, the demographic assumptions when people are retiring. We're projecting the benefit payments. So, as actuaries, that's the core of what we're doing. We're trying to match the assets with the value of those benefit payments. And obviously they're not always going to be exactly the same. So what do? We have contributions to balance that out. The assumptions, as I said, are the key for the assets and benefit payments. The actual methods are how we allocate those contributions to keep things in balance. Since we're not recommending changes, so I'm not going to spend a whole lot of time here, but I did want to highlight just two of sort of the headline actual methods, so to speak. The first is the actual asset method. We often call that asset smoothing. We smooth asset gains or losses, and when actuaries say asset gains or losses, that's how did we perform to our assumption, our 7% assumption. And then so we smooth that. We just recognize that over 5 years, which creates a lot smoother pattern. And if you think over the last 5 years, the employer contribution rate has been very stable, just moved up or down by 0.5% or probably about 0.5% or less each year, which for actuaries, that's close to actual nirvana. We've got nice stable contribution rates. But if we hadn't smoothed, we had 1 year, I think we had 25 plus return, of 1 year we had slightly negative return. We would have seen the contributions rates going up 5% and then down 5%. So obviously not optimal. But we've definitely seen the asset smoothing work. As I said, we've hit that smooth for the last 5 years. Amortization method is the other key one that we've talked about quite a bit in the past. And that's how we pay off the unfunded amount. And we use the 20-year layered method. And we believe that's a good trade-off between paying down the unfunded amount and also keeping the rates fairly stable. So like I said, no recommended changes there. So we're going to move on to the next slide. Just going over the economic assumptions. Once again, I think this is a slide that we also talked about at the offsite. So I'll go over this quickly. Obviously, investment return is kind of number one assumption on the economic side, projecting what investment earnings you're going to get in the future, because what you don't get in investment earnings need to be made up with contributions. So obviously a big part of the actual equation. The next two are national price inflation and local price inflation, which are exactly what they sound to be. How much do prices go up, or we assume that prices go up each year. One is on the national basis, which is reflected, for like example, in the PEPRA compensation limit. It is defined in law that that's based on national price inflation. But when you look at like the COLAs, statutory COLA, that is tied to local LA inflation. So therefore we have two assumptions. Currently they're equal. And I'm going to talk a little bit about those going forward. The next two that are kind of tied are general wage growth and payroll growth. So how much wages go up. Obviously, if wages go up and your population stays the same, your payroll is going to go up by about that amount. And I'll talk more about those two later also. And I already touched on future retiree COLAs, which obviously are tied to inflation, but they're not exactly equal to inflation, because you have the COLA banks, so you could have bigger increases, but you also have caps on the amount of COLAs, particularly for the newer plans, which are capped at 2%. So moving to the next slide. So this is kind of another way to look at it. These are the LACERA's current assumptions and how they're broken down into components. As you can see, inflation is a key component, as I talked about. Even in the investment return assumption, the price inflation isn't directly reflected in there, but to the extent we expect more inflation, generally long-term, that we're going to expect higher returns. Think about a simple case. You think about bonds, fixed income. If you have high inflation, people are going to want a higher return on their bonds to offset that inflation. So there is a somewhat of a correlation between price inflation and real rate of return. So I talked about PEPRA compensation limit. That's directly tied to national price inflation. Then moving to the ones that are tied to local price inflation, individual salary increases go up. We assume they go up by price inflation, and they're not necessarily going to go, but there is definitely a historical correlation there. But there's also real wage on top of that price inflation, and that could be historically, and I'll show some charts on that. Historically, wages have gone up more than prices, and that's because of what generally we call real wage, but it's basically productivity. Individuals can do more in their job than they used to be. It was, we used to talk about computers, and now it's, AI. So in theory, people are going to get paid more because they can do more. And then lastly, COLA, and I talked about that already. So moving to the next slide. So as I said, inflation is kind of the core of a lot of the assumptions. So I'm going to talk about that first. Price of when you think about the experience today, Ted talked about how we do analysis, what happened, and what we expected to happen. We do comparisons. That's primarily on the demographic side. When we're looking at what happened and making adjustments. The demographic assumptions are going to be tied primarily to LACERA's experience, what actually happened with LACERA, whereas on the economic side, we're relying on economic experts, and we're doing, who are doing forecasts of what's going to happen. And you can see, so here's some national price inflation forecasts from a number of people. You can see 2.45, 2.4, 2.3, 2.7, 2.4. So they're kind of in about around that 2.5, which 2.5 is the most common assumption used by large public sector retirement systems. We think is a reasonable assumption. It's a little bit less than LACERA's 2.75. So I want to talk a little bit more about that. So if you look at on that northeast corner of that graph, that shows actual inflation, shows the national in blue, and it shows LA in green. And it's a little hard to tell. You can see there's a pretty significant correlation between local inflation and national inflation, but there are some differences. And we've tried to distill that down in the lower graph there, which shows a comparison of national inflation versus price inflation. And this is a 10-year rolling average, because if you look at individual years, it goes all over the place. But over 10-year average, you can really see a trend developing there. Over the last 20 years, that blue line, that shows LA inflation minus national inflation. You can see over the last 20 years, LA inflation has been at least what national inflation has been, and it's averaged about 20 basis points higher. So what we're going to suggest the board consider approving is splitting the national inflation and the price inflation. You're probably not, as like, you're probably not surprised that, local price inflation has been higher, but keeping the price inflation at 2.75, but lowering that national down to 2.5. So it'd be a pretty small change. And we haven't run numbers yet, and we will give you numbers in December, but I think it would have a small impact. And my spidey sense, it's a little weird because the only thing national inflation directly reflects is a pepper compensation limit, which it affects things kind of different ways and not necessarily intuitive. But my guess is it'll result in slightly lower PEPRA member rates and slightly lower employer contribution rates, but I have to run those numbers, but I would expect it to be small. Moving to the next slide.
Before you move on, real quick.
Yep.
So before there was PEPRA, I understand that, the change of Searle, that they have to use that national, and for this actuary cycle, it came in at 2.5 was the national.
Well, I mean, we reviewed it. There's a range of them, but we think 2.5 that's typical what systems are using, and we think that's reasonable. So we think it's reasonable to lower that one, but given particularly, and I'm going to talk about this a little more, we've been getting what we call actual losses on salaries because salaries have increased more than assumed. So we're a little uncomfortable. This is like lowering expected, by lowering your price inflation, you're kind of lowering expected increase in the salary. When we've had this period where we're having hires, we've expended higher things, but by lowering just the national, that's not going to affect what we're projecting for future salaries.
It gets it closer. And so before PEPRA, when you made the assumptions on the inflation CPI, was it just the LA Anaheim model that went into the assumption, like a local value, or did you?
Well,
you have to go national now, but
right now we're sort of forced to differentiate it. Before, you're kind of hit on the point. Yeah, before we didn't differentiate as much as we're differentiating now because that one key component is tied directly to national price inflation.
Gotcha. And then the last thing I got, I don't mean to, I'm just trying to learn here, is we're in a triennial, so we're doing that kind of love child between the national and the local. And I like your chart with the demonstrating that 0.2% above the national average. But outside of that, when it's just the annual, would you use the same assumption and methodology, or would you just strictly go with the national per Searle?
When we're doing the annual valuation?
Right. We're doing a triennial now, so we have to look at it in totality.
Well, then we'd take those and apply those. So when we were when we're projecting Pepper member benefits, we're going to say we're going to assume, because our assumption is for local price inflation, it goes up 2.75, plus there's some other components of what we project member increases go up. We're going to project the salary is going to go up by 2.75 plus some other pieces, but we're going to assume the Pepper compensation limit only goes up by the national by the 2.5.
Okay, gotcha. But then the triannual though, you kind of like what we're doing now is put it all together, right?
Yeah, well, yeah, we're kind of isolating the pieces and then we're going to put them all together when we do the valuation. Yeah.
All right, thanks for clarifying that.
Oh, you bet. Okay, so like I said, we've had salary losses over the last few years. So you think with all the investment games, you think actuaries might actually get a night's sleep, but there's always something that's going to keep us up. And this time it's kind of those salary losses. So we kind of wanted to get a good feel on that. And so we've got a few more slides on this than we would usually talk about. But I think it's a worthwhile discussion. So first off, before we get general wage, so that's just the increase in pay. Like I said, that's the impact of prices plus a small piece for productivity. Generally, if you assume a stable population, if wages are going up by say 3%, then you'd expect your payroll to go up by 3%. As you can see, our current assumption is 3.25 because we have that component that's local inflation, 2.75 plus the 0.5% real wage growth, sometimes referred to as productivity. This is pretty typical of what other systems are doing. It's important because we're projecting salaries based on that. So I will move to the next slide where we kind of talk a little bit more in detail. And you can see these are national statistics. As I talked about, wages have historically gone up higher than prices, and this shows the last 5 decades. You can see each of those decades has actually gone up more than 0.5% above what national CPI is. Now, I would note, obviously, that obviously I work with a lot of public sector systems, and what applies, this is national, and this is typically private sector employees is going to be the bulk of it. We have not necessarily seen that same growth on the public sector. And you can see that we did analysis for LACERA separately on the chart on the right. It shows that wages grew only about 0.3% more than CPI. So where we're going to end up is we're pretty comfortable at that 0.5. And obviously we've seen those national statistics, but as we said, those are not specific to LACERA, and we think the 0.5 remains reasonable. It's also tricky to, when you think about, obviously, when you have periods of high inflation, that's typically going to flow through into member salaries. But when it does, it's not necessarily going to do it that year. It may be a couple years down when the contract's renegotiated. So it is a little difficult to isolate that one piece of wage inflation above the CPI, but well, we feel pretty good about it. And lastly, the lower right-hand chart just kind of shows our expected general wage growth and payroll assumption. And you can see, particularly over the last about 10 years, it's been pretty much the orange bar is the assumption versus the blue bar. The orange line is the assumption versus the blue bars has been pretty much on point. Moving to the next slide.
Yeah, Nick, that's a great point. I'm glad you guys are accommodating that, because the contractual impact, right? Like if you get a 9% contract over 3 years, but it takes 6 years to get the contract done. It definitely doesn't keep pace with it, and it goes to each individual bargaining unit.
Yeah.
Out of 112,000 active members, it's
we do our best. We do our best to account for that, but we know we're not gonna be spot on. So we just realize that our numbers are not perfect. So looking at total wage growth, that's what an individual member is expected to earn. Each increase in individual member we're assuming is going to have an increase for the next year. You can see the three parts I talked about were the local inflation plus the real wage growth, which is hard to see because it's a pretty small piece of it. And then the third part, which I alluded to a little bit earlier, was merit and longevity. Obviously, you know, if somebody sticks around, you know, I know in contracts, there's longevity increases. You know, you may get a promotion, you've been working somewhere along, or you move up in class. So typically those are bigger. You can see this graph is based on service. Those red bars indicate increases over time. And as you can see, we expect early in a member's career, they tend to get bigger increases. There's greater room for growth. And as they get later on in a career, there's probably less, you know, opportunities for promotion. You might have, you know, maxed out your classification. But the key point here is that blue line there, that's what our assumptions would have predicted over this period, which was about the last three triennials, so last 9 years. You can see that blue line is less than the total. And that's what I was talking about. We've had salary increases. We come back to you most years and say, hey, the liabilities went up more than we expected because salary increases more than our assumption were. So we wanted to, Craig and I want to kind of get to the bottom, you know, what's causing that. We want to kind of identify this now and not have this occur going forward. Well, the first thing you'll note here is that blue bar is about 3.5%. So over that 9-year period, Los Angeles inflation was about 3.5%, which was greater than our 2.75% assumption. So having high inflation has at least indirectly contributed to higher wages. And that's definitely been a factor. And I think we can see that better on the next page. The next page, we've taken out the CPI portion. So this is just because the CPI has been greater than what we've assumed. And this basically takes out that from that. And you can see once we take that out, the combination of the real wage growth and the merit salary has been pretty darn close to our assumptions. So really, it's only been that high inflation that's kind of has been the main driver of those salary losses we have. So we're pretty comfortable going forward that we expect somewhat lower inflation, but we're not lowering. But like I said, we didn't want to lower the local inflation assumption, but keep it the same. So bottom line, we feel pretty good about where the wage growth is, and we recommend keeping that at 0.75, keeping the local inflation at 0.275, but then lowering the national. So moving to the last one, the last assumption, which is the biggest assumption, and we spent a lot of time talking about this at the offsite, which is the expected return. You heard from our capital market expert on that, and obviously I think you're pretty aware their assumption is 7%. So we're assuming LACERA is going to earn 7% every year, and we know Mr. Grable can make that happen, 7% like clockwork. But no, but but we know that's not going to happen. But over time, we do think 7% is a reasonable expectation. You know, knowing that some years will be higher or lower. And I'm just going to start here with, obviously you heard from our capital market expert. I'm going to start with the Milliman column there. You can see the 10-year, we expect 6.7%. That's a little bit lower than the 7% assumption. I should note that our numbers have been adjusted all the numbers have been adjusted for expenses. So, and then if you take it to 20 years, you're at 7.2%, which is a little bit greater than the 7% assumed return. So, you know, if you just look at our numbers, and those look great. 7% just seems, I think it's a no-brainer. You just keep it. But, you know, we don't claim to be the only expert. So we also looked at some other numbers. Obviously, we looked at your investment consultant, Makita. We also went looked at this Horizon survey, which is a survey of a whole bunch of investment consultants. And what you note is that our number is lower in that 10-year, about 0.5% lower. What I would note is that because we're trying to set up assumptions for the June 30th, 2025 valuation, our capital market assumptions are updated every 6 months. So therefore we updated our assumptions. So our assumptions as of June 30th. So they're not exactly apples to apples with the Makita numbers, which are beginning of year, or the Horizon numbers, which are beginning of year. And you heard from Makita, which that they're expecting there's probably going to be some lowering of their capital market expectations because of the big run up in valuations. And that's exactly why that our number is lower. Our number was actually 7.2% as of the beginning of the year. So really our numbers are, particularly the 10-year numbers, are very consistent. It's just that we've updated to 630, and that's why they're a little bit lower. And then the other firm's supposed to have a little bit more higher expectation longer term than us, which I think is obviously there's differences obviously because of the June 30th versus the beginning of the year, but also because I think there's some slightly different expectations on reversion norm, and I'm not going to go into any analysis on that. But bottom line is we're very comfortable at 7%. There is, in the past, we've come into you and talked about, well, our expectations are less than 7%. What are we going to do? Now they're a little bit more than 7%. So it's definitely a nicer situation to be in. I'd note that this is pretty much a situation that most public sector systems that I work with and others that anecdotally I've heard about is they now have, after years of lowering their assumption, they now have higher expected returns, and almost all of them are kind of just staying the course. And I think that's because raising the assumptions is easy, but if you have to lower the assumptions, it's always very painful. So keeping that stability is a good thing. So I think that's probably one of the reasons people have been maintaining their assumption, and we think it's reasonable to keep it at that current 7% level. So moving to the last slide. I've already hit on all these. Like I said, the one thing that we're recommending the board consider is approving national price inflation lowered from 2.75 to 2.5, but then keeping the local price inflation at 2.75, and all other assumptions would remain the same. So that concludes my remarks. I'm happy to take any questions.
Good morning. Thank you so much. Going back to the smoothing for a moment.
Yeah.
I completely understand why we do that. Is there a way we can also get the jagged numbers though, just so for comparison, just so we see how different it is?
Yeah, we could do that. We could just maybe toss in a slide for the next one. And I just note that in the annual valuation, we always report, obviously our focus is on what the actual contribution rate is, but we show the funded ratio and the contribution rate if there were no smoothing. So that's why it's going to be easy to go back and get that, because we have that in all our reports.
Great. Thank you.
Anybody else? Well, excellent. I would, it's very well thought of. I mean, I know it's a lot, and it's, it's not throwing a dart at a dartboard. I mean, it's the process is what it is. I still don't understand why it has to push out 20 years. But it's not my place really to worry about that, but or to even have any influence over it. But when you model it out, it goes out so
Oh yeah, well we obviously the benefit payments are way out in the future,
right?
But just for reference, it's like this is getting a little technical, but kind of what we call the duration, kind of the average payment is about 15 years out in the future. So basically the value of the future payments after 15 years is equal to the value of the payments over the next 15 years. So going out 10 to 20 years in our in our investment return assumption, I think is prudent.
It's prudent and totally appropriate. Yeah,
Yeah.
see, there's where I
But-
try to
Yeah,
equate it to
but-
fire, where I try to equate it to firefighting. The fire behavior environment today is not going to be.
Yeah,
what it
that's,
is. So
yeah.
It
but we-
doesn't fit.
It kind of, we're
Damn
kind of forced to that, but projecting, these things out 75 years. I mean, we have to project out benefit payments, but trying to project out investment return assumptions 75 years, that's not going to make any difference to your current thing. But 10 to 20 is kind of that sweet spot, we think that.
Gotcha. Well, it's well thought of. I'll move to adopt the recommendation. I think it's good. And if it creates a little more functionality and maybe some stability and helps, I would move to adopt the recommendation.
Is this is approval at this point, and then.
Or that's coming back in December. I'm sorry.
Yeah.
Right.
Okay. All right. Never mind.
But yeah, if you can just give us direction to proceed with the economic assumptions we recommended, that'd be great.
I would say go for it.
Okay.
Yeah, today is just a report, and Milliman was just looking for a little bit of direction in terms of preparing the actual report for December.
Yeah,
So-
unless anybody has any other comments, I think it's well done. And Ted, do you have anything to add to it? Or?
No, I don't have anything to add at this point. Milliman will obviously work on the experience study, and they'll have a full presentation for the board. So if there's any questions at that point, we can address those then.
Okay, thank you. I was just overeager. I was excited about it. Thank you.
It's fine.
Appreciate the comments and questions.
Great. Thank you.
So item 9B through 9. Let's see, we have,
Everything else is checked.
yeah, that's what I was looking at. 9 Bravo to 9 Golf. Without any objection, we move to receive and file and move on to the other part of the agenda.
So
Okay. Good. Yep. All right.
We have 2 items for staff review. The first item is to look at the mid-cycle capital market expectations. And then the second item is for Milliman to provide a slide regarding the non-smooth contribution rates. What was yours? Was it a slide? We'll go back to the.
Okay. I'm having a senior moment.
is that the first
it's
meeting?
okay for staff.
That was for the corporate governance.
Oh, gosh.
We
See,
got
there
that
you
one.
go.
Yeah.
All right. It's all running together. Thank you. All right. Item 11. Future agenda, nothing. Good to the order.
You want me to go on? Mr. Ruth, for good of the order?
Oh, I'm good.
Ms. Mead?
Of order.
Okay. Ms. Proft? Mr. Gaza? Mr. Jones? Ms. Langton?
Yeah. Today is my 1-year anniversary at the Board of Investments. I started last October, so I'm 88 meetings shy of Mr. Grable's, situation. And I have to say, I've learned so much, obviously, this last year. And I love this job, and I love it because of the people and the incredible work you all do. It is so, what did I write? Excellent. The excellence of work here, and I greatly appreciate it. And thank you for making this so easy for me. I really, truly appreciate your hard work.
Thank you.
Yeah, that's very well said. And I echo that. It's you guys are, like we said at the summit, I mean, this is a professional organization and it's definitely recognize the efforts that everybody puts in, the flexibility. So thank you for those comments. Without anything else, we can get into, anybody else have a good of the order? Staff? All right, we'll get into executive session.